Hello and welcome to Cafe Mutual YouTube channel. After several years of not so good show, Infra has once again taken a center stage. In fact, the category has delivered over 35% returns in the past 1 year. To understand the future course of infra sector, today we have with us Sanjay Doshi, Fund Manager Equities, Nippon India Mutual Fund. Sanjay has over 18 years of experience in equity research and fund management. So let's welcome Sanjay. Good evening, Sanjay.
Good evening, Nishant, and thank you for having me on your show.
So Sanjay, so as I've already mentioned that so infra funds are among the top in the performance chart these days. So what is driving this
Right.
revival?
Yeah, true. I think it will not be wrong to say that the sector has got its mojo back
Yes.
after a long period of time.
Mhm.
And to our mind, it's basically the pace of the investment cycle or where we are in the investment cycle has a lot of bearing on the performance of these funds. So if you look today, we probably have seen the start of a new investment cycle, which is just probably 1 or 2 years old. And
Mhm.
this has come after a period of 8 to 10 years where the overall growth in infrastructure investment has been very subdued. So it is coming on back of a very long period of subdued growth. But we have seen today, in terms of revival in business sentiments, we have seen a pickup in capex, and therefore the opportunity of growth for the companies in the space has improved meaningfully. And this is what has brought the investors back into the space. And I think that is one prime key reason why we have seen the improvement in fund performance for this space.
Okay. But what about your views on sustainability of this rally?
Right. Yeah, that's a $1 million question. So, to our mind, we are just at the beginning of a new cycle.
Mhm.
And past experience also suggests that normally the cycles are of around 6 to 8 years, if not more. So,
Mhm.
in that sense, we remain fairly confident that we should be able to see robust growth in infrastructure investment and manufacturing capex over
Mhm.
the next 3 to 5 years. And obviously, the basic assumption here is that we have macroeconomic stability and we
Mhm.
have government continuing with its policy support. So, if
Mhm.
I try to break it up in terms of how we analyze the capex cycle, so
Mhm.
on the government side, we see the focus on infrastructure investment continuing. These investments have an multiplier effect on the economy. They have a lot of employment generation potential. It helps to reduce the inefficiencies in the economy, like you say, higher logistic cost or power cost.
Mhm.
And overall, it helps in sustainable economic development for a long to medium term, right? So the government, I don't think, is going to deter away from its economic reforms agenda, and it will continue these investment which are directed through the National Infrastructure Pipeline Gati Shakti program. If you look at government steps to revive private sector investment, that has also been quite positive. So
Mhm.
if you look at the corporate tax cut that we saw preferential treatment on tax for new manufacturing facilities. And now we have the most important economic reforms for supporting manufacturing, which is the production linked incentive schemes. So the
Mhm.
government seems very committed in terms of overall improvement in infrastructure spending. If you look at the other end, that is a private side, which probably really determines the strength of a cycle.
Mhm.
There we have seen improvement in business sentiment. We have seen confidence to look at new investment as utilization levels of existing assets have improved meaningfully. So
Mhm.
even if you look at on an aggregate basis, we are above average levels of utilization. We have also seen the cash flow improvement for these companies. We have seen the balance sheet improve over a period of last 4 5 years. So there is new financing available if they look at fresh investments. We have also seen benefits of geopolitical side in terms of China plus one, Europe plus one strategy when we look at realignment of global supply chain. So
Mhm.
that is also supporting new investment decisions in the country. And to our mind, apart from the PLI scheme, there would be commitments on capex for meeting your long-term carbon goals, which is basically your decarbonization or energy transition spends. And we have seen benefit of digitalization or industrial 4.0, where you're able to utilize your assets in a much more meaningful manner. So I think those investments will also continue. So in a very simplistic way, we are very confident that we should see a continuation of these growth for the next 3 to 5 years, and we see definite pickup in private capex over the next coming years.
But Sanjay, interest rate has a huge role to play here, right? And yeah, and since
So yeah,
yeah, yeah,
to an extent you are right that interest rate will start making an impact. But what is more important than that is the business outlook. So if you are very confident about your ability to utilize assets at a decent returns, I
right.
think finance availability is first criteria, and
Mm,
thereafter the evaluation on interest rates. But if your business outlook is not supportive, you will still not invest.
mm,
So interest rates do get reevaluated into your project cost, and therefore your ability to generate decent IRRs. As we speak today, I
mm,
think the interest rate hike that we saw has really not been so detrimental for new investment. And
mm,
probably we are at a fag end of an interest rate hike cycle. So in
mm,
that sense, also we are not very
mm.
worried about interest rate making a very large impact on new investments.
Okay. So Sanjay, many experts shy away from infra and power companies as these companies are highly leveraged. So what is your comment on this?
Oh yes, that's quite well pointed out. Leverage had become an issue when we had overcapacities in many subsegments, and there was a macroeconomic slowdown, so utilization levels went down. So definitely, those became an hindrance in terms of capital for new investments. But if you look at the nature of the business, if you're looking at setting up of a power plant which is having a life of 30, 40 years, or
Mm,
an asset which has life of 30, 40 years, you will require a desirable amount of leverage. It is impossible to finance everything on equity.
mm,
So the nature of the business is requiring investments or leverage. But it would be very right to point out that investors have to be very cautious and careful about this aspect.
mm,
We have to understand the business model.
mm,
For people who are having long-term assets, a desirable leverage is fine. But if these leverage is mainly for supporting working capital, that basically shows weakness of the business model. So
mm.
yes, one has to be careful about the leverage aspects. And today, I think we are still very comfortable in terms of the ability of companies to look at new investments, taking on a reasonable amount of leverage.
Sanjay, talking about Nippon India Power and Infra Fund, so it has outperformed all its peers and category by a wide margin, especially in the last 1 year. So, what has contributed to this significant outperformance?
Yes, we have done relatively better. I think to our mind, a few factors have helped us in terms of fund performance. I think first and foremost, we were able to assess the revival in the cycle probably a bit early on. And
Mm,
therefore, we were able to position the fund to benefit from the revival that we saw in the last couple of years. And hopefully that will continue. Also, I think we were able to identify certain themes or certain areas where we saw structural reforms or structural changes happening,
mm,
and therefore the scope of re-rating. Like, for example, say defense indigenization, we were probably too early on to catch up on that theme.
mm,
It had a very large portion in our fund. Similarly, railway capex or manufacturing, industrial manufacturing. So, some of the themes we were able to identify early on. Similarly, there were certain mid and small caps in the engineering space, in the cement space or construction space, where given the business model and the revival in cycle, we thought that there was a huge scope of re-rating. And
mm,
that to an extent has started to play out. So I
mm,
think what has helped us is being true to the product. That is, we are fully focused on the theme. We were able to assess the revival a little bit early, and we were able to identify certain themes or areas where there was significant favorable risk reward, and
mm.
therefore we saw re-rating. So I think these factors have helped the performance of our fund.
Great. So Sanjay, an analysis of fund portfolio shows that the fund has over 50% exposure to large cap companies. So what's the rationale behind this?
Yeah, we wanted to have a more balanced portfolio, honestly. So these large caps are basically the leaders in the various subsegment of infrastructure investable universe. This kind of weight of 50-52% that we have in our fund today, it helps us to manage volatility and provide liquidity to the fund. Not to forget that these large caps also benefit from consolidation, which is happening in the industries. And these are probably the best companies to be able to leverage as the cycle picks up because they have the strengths in terms of balance sheet, in terms of capabilities. So it's an objective of meeting a balanced portfolio, having to manage volatility and liquidity, and at the same time, bank on the leaders who have some technology advantage or who have the ability to scale quickly. So that is a basic thought about having these large caps in our portfolio.
Sanjay, also the fund has decent exposure to small cap companies. So, what drove you to choose small cap companies, considering they are they are not so liquid?
Yeah. So if you look at the overall investable universe, when we talk about infrastructure investment or manufacturing capex led stories, I think you will find that a significantly large portion of these companies are small caps or mid caps. So that's the nature in terms of the cycle that we are in terms of macro context. But given that fact, also, we have been fairly conscious about our small cap exposure. Today, the fund would have around 27-28% of the holding in small caps. We particularly take care about the leverage of these companies and also the business models. So a company which will have relatively weaker footing or which is more price-driven business model will not find a space in our portfolio, especially in the small cap space. But if you look at certain subsegments like niche engineering companies or industrial product companies, or say industrial electronics manufacturing companies, most of these companies are still small cap in nature. So, therefore, considering the positioning, the opportunity that we see over the next 3 to 5 years, we believe some of these with the strong business model will be able to have a long runway of growth. And this will followed by re-rating. So that should support the alpha generation for the.
Sanjay, capital goods, energy, and construction make major part of the investment portfolio of the fund. So, what are the reasons for that?
Okay, so from the portfolio overall construct perspective, when we look at the opportunities which within the various subsegments, we would focus on areas where we believe the opportunity for growth is higher and probably for longer period of time. So if I take an example, say energy transition or decarbonization, some of these capex will continue for next 10-15 years or even higher so time period. So that is the kind of capex intensity we'll see in this subsegment. Similarly, say areas like defense indigenization or railway capex, data centers, say areas like mobility infra. If you look at the medium speed train like Vande Bharat or the high speed network or the DFCCs, these will have relatively longer runway of growth. So what we are trying to do in the portfolio is to position ourselves in these subsegments where we believe the growth rate will be higher and probably for longer period of time. And this will be a combination of large cap companies, which will be leaders, or a very niche mid cap companies in the energy, capital goods, and allied spaces. So that is how the portfolio construct is worked upon. Overall, if you look at our portfolio, that is the Nippon India Power and Infra Fund, we would have exposure across various subsegments like capital goods, energy, engineering companies is the highest, followed by energy. Then they will have power utilities. Then there will be telecom, defense, logistics, real estate, cement, construction. So these are the various subsegments that we have invested into.
So, Sanjay, one last question. Why should MFDs recommend Nippon India Power and Infra Fund to their clients?
Important question, but yeah, before I come to the fund, I think it is important to highlight the peculiarities of thematic product. So one needs to be careful about these products in terms of the volatility, in terms of the cyclicality of these products, as well as the liquidity part of it in terms of diversification. So the individual risk appetite has to be weighed, and therefore the weight of these products in the overall portfolio has to be taken care of. Also, I mean, considering where we are in the market and the cycle, I think it will be prudent to take investors from a 3-year kind of view in terms of equity allocations. So having said these important part, I think for the Nippon India Power and Infra Fund, I strongly believe we are well positioned to capitalize on these medium-term growth opportunity that we see for the next 3 to 5 years. We are trying to have a balanced portfolio, as I mentioned, across various subsegments of infrastructure, which is say physical infrastructure, digital infrastructure, and social infrastructure also. So there's a balance across subsegments. We have a good balance across market cap, say the large cap companies, mid cap companies, and small cap companies. We would try to keep a good balance so that overall volatility is managed as well as liquidity is taken care of. We would be very careful about small cap exposure, especially in terms of their leverage and liquidity. We would try to avoid huge weights in companies which are more price driven businesses, say like oil and gas or metals. So you will not find very high proportion in terms of our portfolio construct. So overall, I think having a balance as well as trying to make the most of these cycle by identifying certain niches, as I highlighted, like say energy transition, manufacturing going up in the overall space, or looking at defense, real estate. So some of these themes we will try to position ourselves so that we optimize return for shareholders and at the same time try to be a balanced portfolio and avoiding any significant high exposure to small caps. So in this overall context, I think the investor can expect us replicating the growth which is available and therefore the potential for returns.
All right, we have come to an end to this interesting session. Thank you so much, Sanjay, for your time.
Thank you, Nishan. Pleasure.
And finally, I thank each one of you for being such a wonderful audience. Have a great day at work, guys. Bye.